Power is now a very important piece of the AI narrative. And so I began to look into some power plays and I came upon Vistra, VST. And so Vistra has been trading at over $200, around $220 a share, and now has dropped down to $166 per share. So I thought this would be a good time to go through their business model, their moat, their headwinds, their risks, competitors in the space, their historical financials, their recent earnings, and then wrap it up with a valuation. And investors can see whether Vistra is a good investment for the long term or not. So if you like this content, please like and subscribe, and let's get straight into it. Now, Vistra is a leading Fortune 500 integrated retail electricity and power generation company. It's based in Texas. It provides essential resources to customers, businesses, and communities from California to Maine, so it's completely nationwide. And they are a leader in transforming the energy landscape, focus on reliability, affordability, and sustainability. The company safely operates a reliable, efficient power generation fleet of natural gas, nuclear, coal, solar, and battery energy storage facilities. So they're really in the whole gamut of energy plays. They go from coal and other fossil fuels to nuclear and battery and solar power. They have a lot of operations in Texas, some in California, a lot in Illinois, some in Ohio and other places. And they're in so many different operations. They produce energy from so many different sources. They have natural gas, they have coal, they have nuclear, solar, and then straight up batteries. And they do all of these things, and it really allows them to weather any type of environment, because they're not just relying on coal, they're not just relying on nuclear, they're not just relying on solar or any of these things. They have a wide, diverse network of power generation. They have products and services in 18 states and Washington, D.C., including all major competitive wholesale markets in the U.S. They serve retail. They serve approximately 5 million residential, commercial, and industrial retail customers, more than 50 renewable energy plants. And on the generation side, the largest competitive power generator in the US. They do 44,000 megawatts of generation powered by a diverse portfolio of natural gas, nuclear, coal, solar, and battery energy storage. They own and operate the second largest competitive nuclear power fleet in the US. And this nuclear power fleet is going to be really crucial when it comes to AI and providing energy to these AI data centers. Energy by capacity, 44,000 megawatts, and it's broken down into mostly gas right now. I believe that they're going to be doing more acquisitions in the future and growing these other segments of the pie. Generation by production, 202 terawatt hours, and it's broken down into mostly gas, obviously, and then nuclear is 26%, coal is 20%, and less than 1% is renewables. Now, Vistra does compete in a very competitive industry. So alongside Vistra, you have CEG, which is Constellation Energy, NRG, Energy, NGG, and National Grid, EPD. There's a whole list of competitors in this industry. So this is not a place where they hold a monopoly or even an oligopoly. It's a very distributed market. So that's the type of market that they're in and competing in. Not to say that's a bad thing. It does reduce their pricing power, obviously. It reduces their margins because competitors have also competitive offerings. So the end user does have options in terms of this industry. You'll have to see whether Vistra can stack up in terms of their financials and their metrics compared to these other competitors. So the bulls are saying Vistra's ample cash flow gives it financial flexibility to repurchase stock, invest in growth projects, and pursue small acquisitions. Vistra's relatively new efficient gas fleet allows it to earn higher margins than its competitors that have older, less efficient power plants. And then the retail wholesale integrated business model can reduce the volatility of cash flows and margins, allowing Vistra to be a low-cost energy supplier. But there's also bear arguments, and the bears say that low gas and electricity prices hurt the profitability of Vistra's coal and nuclear fleet. The retail market is highly competitive with tight margins. That's very true. Because there's so much competition, you're going to have very tight margins because there's so many options for customers to choose from. A small operational miscue can lead to large losses. That's also possible. And that's just true for a lot of businesses. They're operating on tight margins because their industry is full of competition. Look at the fintech space. You know how many competitors are there Any type of miscue there will lead to disaster. Environmental regulations could lead Vistra to shrink its remaining fossil fuel fleet. That is also a concern. I would say that's a little bit delayed because the current administration is more pro fossil fuel now. There's also been a lot of news with Vistra, so let's unpack each one of these and go through them. So the first one I want to focus on is their acquisition of Cogentrix. The highlights here are acquisition of Cogentrix includes 5,500 megawatts of modern natural gas generation assets at an attractive purchase price, net of expected tax benefits of approximately $730 per kilowatt of capacity. So this is a natural gas acquisition. So they're increasing their natural gas generation assets. This acquisition is expected to mid-single digit ongoing operations per share accretion in 2027 and high single digit accretion on average over 2027 to 2029. So they did this acquisition believing that it's going to be per share accretive to their business. Reiterating previously communicated capital allocation plan, including a long-term net leverage target of less than 3x. So they're sitting on a lot of debt right now, and their target is less than 3x of leverage. The expected return of capital to shareholders by way of the planned $300 million in annual dividends and at least $1 billion of share repurchases each year. So this is a strong commitment from management to return capital to investors. I like that. I also like that they're calling out their large amount of debt and including a plan to bring the net leverage down to under 3x. So I do like that. I'm not a fan of where their debt is right now. So I'm glad that their management is taking hold of that. The next news story I want to react to is Vistra and Meta announce agreements to support nuclear plants in PJM and add new nuclear generation to the grid. So this is a 20-year power purchase agreement, PPA, that will support Meta operations and increase the energy output in 3 Vistra nuclear plants in PJM. So here, let's look at the highlights of this agreement. Meta is purchasing 2,176 megawatts of nuclear energy and capacity from the operating Perry and Davis Bessie plants in Ohio. Meta is also purchasing 433 megawatts of incremental nuclear energy and capacity from equipment upgrades to increase generation output called uprates at the Perry, Ohio, Davis Bessie, Ohio, and Beaver Valley, Pennsylvania plants. More than 15% of contracted capacity announced today will be new capacity added to the PJM region. Electricity generated at the plants will continue to go onto the grid for all electricity use. Huge for Vistra because we know how much Meta is spending on AI capex. This is part of that AI capex spend. Meta needs all of this power, this nuclear energy, to power their AI and their data centers. I've mentioned in the past in my notes and my social media is that AI compute is going to take a lot of memory. It's going to take a lot of power. And that's the primary, I would say that's the primary tailwind behind Vistra and why it's so exciting to look at this space after so long because of the rise of AI. And I wouldn't even be looking into the power generation segment if it wasn't for AI and the incessant need for power. This is a strong factor in this investment that hyperscalers are now the customers of Vistra and getting their energy from them. So that is a high quality source of revenue. Now, the last piece of news that I want to react to is that Vistra also is pricing a private offering of $2.25 billion of senior secured notes. And so if anyone doesn't understand this, it's basically debt. They're offering senior secured notes as debt to raise $2.25 billion of cash and capital. So Vistra announced today the pricing of a private offering, $2.25 billion aggregate principal amount of senior secured notes, consisting of $1 billion worth of aggregate principal amount of senior secured notes due 2031, at a price to the public of 99.954% of their face value, and then 1.25 billion aggregate principal amount of senior secured notes due 2036. These are far dated notes, and those two together is the $2.25 billion of debt. To qualified institutional buyers, 2031 secured notes will bear interest at the rate of 4.7% per annum, and the 2036 secured notes will bear interest at a rate of 5.35% per annum. That longer dated one has a higher interest rate, which makes sense. The notes will be fully and unconditionally guaranteed by certain of the issuer's current and future subsidiaries that will also guarantee the issuer's credit agreement. Now, let's see what they use this for. So the company intends to use the proceeds from the offering to fund a portion of the consideration for the previously announced acquisition of the company Cogentrix Energy. So this is part of their acquisition of Cogentrix Energy, general corporate purposes, including to repay existing indebtedness and to pay fees and expenses related to the offering. So basically the reason they're doing this is to pay off the debts or to consolidate the debts that they had from the Cogentrix Energy acquisition. This offering is going to close in about 3 days as the recording of this video. So it's more of a consolidation. Okay, so let's get into their financial metrics and historical financials here. So here their market cap is about $61.05 billion. So they're not exactly a small company, but they're not exactly a huge multi-hundred billion dollar company or trillion-dollar company. So this is important. The difference between the market cap and the EV, the enterprise value, is traditionally their debt. That's a pretty large amount of debt right there. Now their shares outstanding about 338.7 million. Revenue, I guess this is trailing 12 month, is 17.19 billion. And so that's important because they do make a lot of revenue for their market cap. But since they have so much debt, this would be, if this doesn't get caught up in expenses and other things, CapEx, this should hopefully go towards paying down their debt. They have about 6,850 employees. Their margins, they have gross margins at 34.8%, EBITDA margins at 30.3%, operating margins at 12.7%, pre-tax 7.4%, net is around 6.7%, and free cash flow is about 9.6%. Free cash flow percentage margin is not bad, at around 10%. Their trailing 12-month PE is very high at 64.9. So that's not great. Their price to book is 22.3, but let's look at their next 12-month valuations. So the price target that analysts have is about $230. The PE is 17.3. So their PE drops drastically over the next 12 months, according to analysts. PE over growth rate is 1.7, keeps going down closer to 1. It could be even more attractive to long-term investors. EV to sales is 3.2, EV to EBITDA is 10.8, price to free cash flow is about 15.9. Now they have $620 million in cash, but their net debt, as I've mentioned, is it's about $17 billion. So that's really high. So that means their debt to equity is 3.4. Now looking at their historical financials, you can see that about 10 years ago, they were making about $6 billion in revenue. Now they're making about $17.224 billion in revenue. And a lot of this, I think this has room to grow. The revenue has room to grow as they're getting hyperscaler customers, providing more and acquiring more fleets, both fossil fuel and things like nuclear and other projects, especially with this AI narrative going on right now. Their gross profits are a little spotty. They really got a hit in the COVID era. Recovered nicely, and they're now sitting on $6 billion of gross income. In a company like this, you want to look at their D&A, the depreciation, because they have a lot of assets that they could be depreciating. So you can see that it has been rising since 2023, now up to over $2 billion. And what else? Operating profit, let's look at that. That has been a lot more spotty. You can see the hit in COVID, and here that has been recovering nicely. So now they're over about $4 billion in operating profit. So their operating margins, let's compare those two. So their operating profit margin has been over 10%. Another thing I want to look at in this company is their total shares outstanding. And this is really important and critical for me to see in a business is when they're reducing shares and it's actually reducing total share count. So here, around 2018, they were sitting at a high of 493.2 million shares. And since that time, they've been able to reduce their shares to close to 340 million shares. So that's a huge reduction in a very short amount of time. And I really like that program of $1 billion of share repurchases every year. That is a real big capital return to shareholders. Looking at their balance sheet, their cash and cash equivalents, like I said, last 12 months is $632 million. Accounts receivable has been going up and to the right, so that's good on its face, but we have to make sure that these turn into actual received cash on the balance sheet. Their total current assets is 8.381 billion for the last 12 months. Their total assets for the last 12 months is $38 billion. Now, on the liability side, their total current liabilities is 8.426 billion. Their total long-term liabilities is 24.371 billion, and total liabilities therefore is 32.797 billion. I do have more total assets than total liabilities. So one of the major things on this balance sheet that I want to see changed is the long-term debt. I want to see this long-term debt brought down, and that would really do a lot to make this balance sheet a lot better health-wise. Now let's look at the cash flow statement. Here, net income starts with net income always, and you can see D&A is increasing. Their share-based compensation expense is another thing that I like to look at when looking at a company. And if we pull that up, if they can keep this in check under 100 million, that would be nice. Another thing I want to look at is how they're paying their debt. So you can see that the green here is the repayment of long-term debt, and the blue is the net issuance of long-term debt. And so you can see it's kind of a battle between the two. And you would ideally like to see that the repayments are bigger than the blue. And for some of the years they are. And so that will bring down the long-term debt of the company. And on some of the years, it will be less than the repayment. So they're trying to manage it, I believe. They're trying to manage the long-term debt, but we'll have to see longer term whether that long-term debt goes down. And then they're also doing share repurchases. And you can see they do a lot of share repurchases. A few years, they've been doing it over $1 billion of share repurchases. Almost $2 billion in 2022. And now in 2024, they did about 1.266 billion. Okay, so let's go to their most recent earnings report, the third quarter 2025 results from November 6th. Financial highlights here. They're narrowing their 2025 adjusted EBITDA guidance range 5.7 to 5.9 billion. They're initiating a 2026 adjusted EBITDA guidance rate of 6.8 to 7.6 billion. This is a nice increase from the past year. They've contracted 1,200 megawatts at Comanche Peak Nuclear Power Plant site. 20-year PPA power purchasing agreement underwrites plant operations through the middle of the century. Energization expected Q4 2027. Diversified generation portfolio, well positioned to create value in growing demand environment. So I believe they achieved that with, natural gas, coal, solar, nuclear. Strong commercial skills to deliver near and long-term value. Customer-centric retail business providing innovative solutions. Disciplined capital allocation. Board authorization of $1 billion. Incremental share repurchases expected to be utilized through year of 2027. Natural gas expansion including 860 megawatts build in West Texas and 2,600 megawatt acquisition from Lotus. Resilient balance sheet. Net leverage of approximately 2.6x pro forma for transactions closed in Q4 2025 and based on midpoint of 2026 adjusted EBITDA guidance range. Refinanced $1 billion of debt maturing in 2026 at lower interest rate. So yeah, the whole refinancing here was to refinance at a lower interest rate at a longer date. Strategic energy transition, 200 megawatt Oak Hill solar facility in ERCOT reached commercial operations in October. Feasibility studies on potential nuclear uprates expected to be completed by end of year. So they got good strategic priorities here. I think these are aligned with shareholders and their business growing and performing well in a ever-changing dynamics of the industry. So this slide is important because they're saying that growth in energy is going to outpace the growth in peak demand. And the reason for that is hyperscaler CapEx budgets continue to increase, which they are. They have been doing that for many quarters now. And the key markets such as PJM and ERCOT are attracting a growing share of the load growth. PJM, 3% a year to date, and 6.5% at ERCOT. The tailwinds for driving more opportunities for Vistra. Assets will be economically called to run more as demand grows. 22 gigawatts of modern combined cycle gas fleet utilization of 58%, with the potential to achieve up to 85% plus with minimal incremental expense. That is a huge tailwind for Vistra. If they can go from 58% to 85% plus increase with basically no expenses. And so here, this slide is talking about the multi-year execution creating value in evolving power markets. Their profitability and cash generation is expected to increase over the next 2 years. Right now, their guidance range 5.7 to 5.9. I mean, this probably came in line. It's now 2026. They probably already adjusted this. 3.3 to 3.5. And then they're guiding in 2026. 6.8 to 7.6 billion and adjusted EBITDA, and 3.925 to 4.725 adjusted free cash flow before growth in 2026, and then 7.4 to 7.8 billion in adjusted EBITDA in 2027. That's what they're guiding for. Their integrated model in strengthening power markets, capacity growth through gas augmentations and Vistra Zero, acquired over 6 gigawatts of Energy Harbor and Lotus transaction. Additional opportunities for value creation, coal to gas conversions, nuclear uprates, new build, ramp of Comanche Peak PPA to 1200 megawatts, future long-term PPAs at existing nuclear and gas sites, new gas and new renewables development opportunities. So here are the actual results. So they did, let's see, 4.170 billion in both retail and generation combined. So in retail, it was 977 million. In generation, it was 3.193 billion. So the generation was favorable compared to comparable 2024 periods. It realized higher wholesale prices and capacity revenues. Recognition of expected nuclear PTCs, partially offset by extended outages at Martin Lake Unit 1 and Moss Landing battery facilities. And with respect to year-to-date results only, additional 2 months of legacy Energy Harbor results. And then that was on the generation side. And then retail side, Q3 2025 unfavorable as compared to Q3 2024, primarily due to weather-driven gains and expected intra-year timing impacts of supply costs. They are disciplined capital allocators for shareholders. $10 billion approximately expected cumulative cash to allocate between now and 2027. $6 billion expected cumulative cash uses of $3.4 billion for share repurchases and common and preferred dividends, and $2.6 billion for growth, including acquisition of Lotus. And then approximately $4 billion left over projected cash for other allocation possibilities in this next 2 years. So a lot of cash being allocated back to shareholders in one way or another. And these are the ways that they're going to be increasing their free cash flow per share for shareholders. Their continued share repurchases, Comanche Peak PPA, expected to contribute after 2027, additional long-term contracts, capacity expansions, including Permian gas units, improved forward price outlook, potentially leading to higher realized prices. Their nuclear production tax credit, the PTC, is really important. It is a tax credit of up to $15 per megawatt hour. When gross receipts exceed $26 per megawatt hour, the PTC amount is reduced by 80% of gross receipts exceeding $26 per megawatt hour. When gross receipts exceed $44.75 per megawatt hour, the PTC amount reduced to zero. The tax credit wanes after a certain amount, and this PTC can be credited against taxes or monetize the sale and will be recognized as revenue for accounting purposes. They can use this credit against their taxes, reduce their corporate tax rate, or they can reduce the proceeds from a sale. The maximum PTC and gross receipts threshold are subject to inflation adjustments and based on GDP price deflator or for the preceding calendar year. Maximum PTC is rounded to the nearest $2.50 megawatt hour, and gross receipts threshold rounded to the nearest $1 per megawatt hour. Vistra Vision positioned to benefit directly from IRA's nuclear PTC given its applicability to production from its 6,400 megawatts of nuclear capacity. So they're directly a beneficiary of this PTC, and it will really benefit their business. And lastly, let's look at a valuation, a two-stage DCF model of Vistra on Simply Wall Street. Here they're saying that the cash flow value of this company is $352.85. Current price is around $166.6. And so that's about a 52.8% undervalued. And the way they get this is they use a two-stage free cash flow to equity analysis. Their discount rate was about 7.9, is calculated here using the risk-free rate, equity risk premium. They're a renewable energy unlevered beta using that and relevering it, and they got 7.9% for the discount rate. Now, we're using analyst estimates for up to 5 years, up to 2030. They were able to put that in and then use the discount rate after that to discount it into the future for the rest of the time for the 10 years. And based on that, they got a $352.85 share value, per share value. That's what its intrinsic value should be at the current time. So you can see the asymmetric disconnect between a discounted cash flow analysis fair value and what the current price is trading at. So news and sentiment will often affect a price of a stock, and using math, you can see that the actual value of the company is much higher. So this does present an asymmetric upside for investors who are thinking long term. I'm not talking about a few months, I'm talking about multiple years into the future. This could be a great investment for long-term holders, especially with the narratives around AI and around increased power usage and power generation needs for AI and AI compute and AI data centers going forward. This seems like a very strong play in that direction. So what am I doing with Vistra? Well, Vistra provides an excellent opportunity for long-term investors, especially those who are convinced that the AI narrative is going to stay and only going to grow in the future, which I do believe. I would be interested in purchasing some Vistra shares. It does seem like a good opportunity. A lot of asymmetric upside here, and the narrative around AI is not going away anytime soon. These hyperscalers will continue to pour billions and billions and billions in AI capex into companies like Vistra and, memory, things like that. So I do believe this is not going anywhere, and I do believe that there's lots of opportunity to grow in the power segment. They do have a lot of competition, but I think it's not in the energy space like this. It's not going to be one winner takes all. And I think there's a lot of TAM to grow around for all of these companies. So that's it, guys. I hope you like this content. If you did, please like and subscribe, and I'll see you guys in the next one.